Alright guys, so welcome to my computer screen. So I just wanted to show you guys how to increase your reward to risk in Forex. So when it comes to reward to risk ratio in Forex, the first thing to understand is how the actual reward to risk ratio is calculated. So to determine the reward to risk ratio of a given trade, you simply take the take profit distance from the entry in terms of pips, so this is the green part, and divide that by the stop loss distance from the entry in terms of pips, so here the red part. So as we can see here, let's say that the take profit is 150 pips from the entry and the stop loss is 15 pips from the entry, then the risk to reward ratio is 10. So the question is how to actually take trades which have a high reward to risk ratio, and this is actually quite simple. So this video is not going to explain a strategy for taking the high reward to risk trade, but just simply how to increase your risk to reward in Forex. Alright, so we know how the risk to reward in Forex is calculated. So based on that equation, there's really only two ways to increase the outcome of this equation, so the reward to risk ratio. So the first way is to increase your take profit distance from the entry. So you're basically going to take a trade which has a take profit which is further away from where you enter the trade. So the target for the trade is basically further away from the entry. Or you can increase your reward to risk ratio by decreasing the stop loss from the entry. So that's basically having a smaller stop loss, which means that the same distance traveled to the target point will result in a higher reward to risk ratio. So let's just speak for a minute about those two different ways to increase your risk to reward based on the equation. So the first way is to increase your take profit distance from entry. So in terms of how to actually do this, the main thing to be thinking about is getting involved in higher time frame structures and higher time frame trends. So if you're really trading only the 1 minute time frame and you're expecting to get 100 pips out of a move, then that's pretty unrealistic. But if you're trading based on the daily time frame and you're looking at following the daily trend or an impulse to the high on the daily, then 100 pips might not be too much, and you could even get several hundred pips. So to get involved in higher time frame, to get involved in larger moves and therefore increase the take profit distance from the entry, you need to be looking at getting involved in the larger moves using higher time frame structures and trends. So you really need to be looking at getting involved in higher time frame moves because typically they're much bigger than the lower time frame moves. So in terms of the second way to improve your reward to risk ratio, the second way is to decrease the stop loss distance from the entry. So the main thing with this is basically you just need a smaller stop loss. Now, if you're trying to enter a trade on the daily time frame and you're trying to get in with a 10 pip stop loss, then you're probably going to get stopped out almost all the time, really, like very frequently, because on most pairs 10 pips simply isn't enough to take a trade on the daily time frame and have your stop loss in a sensible place. So to still have your stop loss in a sensible place and actually minimize the size of your stop loss, you're going to have to basically enter on the lower time frames. So you need to be looking at going down to lower time frames so that you can find a point which is sensible to put your stop loss at, which is smaller than the sensible point would be on the higher time frames. So if you're looking at entering on the 1 minute time frame, for example, then it might be reasonable to get a 5 pip stop loss, or a 10 pip stop loss, or even a 2 or 3 pip stop loss depending on the pair. So by going down to them lower time frames, even the 15-minute, you can get a lot smaller stop losses than you can if you're just trading the higher time frames like the 4 hour and the daily. So to decrease your stop loss size, you really need to take your entries on the lower time frames and use the structural points on those time frames to place your stop loss. Alright, so overall, to maximize your reward to risk in Forex, you need to be entering the largest move possible with the smallest stop loss possible. So this means getting involved in high time frame moves with low time frame entries. So for example, you might get involved in a 4-hour move or a daily move which has a target of maybe 100 pips, 200 pips, and then you're looking at getting involved in that move by taking a trade on the 1 minute or the 5 minute or the 15 minute, and that could allow you to get potentially anything from a 1 pip to 10 or 15 pip stop loss. So by getting involved in them big moves, you can manipulate the top part of this equation and you can have a large target. And by entering on the lower time frames, you can get involved. You can manipulate the bottom half of this equation by taking a small stop loss based on a structural point on the lower time frame. So before taking any trades, you need to consider what risk to reward you actually want from the trade, and think about what win rate you're expecting and what win rate you'd need to profit based on the risk to reward ratio. So the big advantage with increasing your risk to reward in Forex is that if you have a higher risk to reward ratio, you won't have to win as often, so it takes the pressure off of winning. So always think before you enter the trade what type of target you're actually looking for. So where are you actually expecting price to go to, and then where would your stop loss need to be to enter sensibly on the time frame that you're looking to enter on, and then consider what actual reward to risk ratio that results in, and if that is suitable for the win rate that you're anticipating for that trade. So if you guys do want to know any more about reward to risk and win rates, then check out my video that I previously made called What is an Edge in Forex, because that goes a lot deeper into what risk to reward you need and what win rates you need to be profitable with each different risk to reward. Alright, so I'll just take you guys quickly over to a real example in the real chart so I can show you what I spoke about in practice. So guys, so I just wanted to show you this real market example of what I've been talking about. Alright, so let's say that we're looking at GU here on the 4-hour, so on the higher time frame, and what we've noticed is there's basically been a break of structure below this point with this wick, and then price has actually failed to come up higher. So what we've essentially had is a break of structure, so the institution's pushing price down, and then a mitigation, or you might call it a pullback back into the high of this range. So what happens after it reaches the high? It fails to break up and it actually breaks down further. So we now have a second break of structure. So this is really indicating on the 4-hour time frame that the institutions are looking to take the price lower down. Now, where does this actually come from, this break of structure here? Well, it really comes from this wick here. So in terms of the way my strategy works, I'd pretty much be looking at selling from this wick. Alright, so if I was just to take a trade based just on the 4-hour time frame alone, then I'd probably be waiting for a reaction and then looking to place a trade with my stop loss above it. Alright, so let's say we take a trade here, let's have a stop loss slightly above, so 35 pips. So if I take the trade here on the 4-hour time frame, then I'm looking at taking it with a 35 pip stop loss. Alright, now let's go down to a 5 minute and I'll see if there's an entry that appears on the 5 minute. Alright, so on the 5 minute, what we've essentially had is, I fast forward it a bit too far there, but yeah, what we've essentially had here is we get a break of structure 1, so the first break of structure to the low indicates that price is actually reacting off this point, and then a second break of structure here on the 5 minute really confirms that price is actually going to go further down, or most likely at least, the institutions have started to push price further down. So here we can see a break of structure down, and then it fails to push higher than this point here, where this order block which caused this break of structure down. And then after failing to push higher, we actually see another break of structure. So at this point I'm looking and I'm thinking, where is this break of structure originated from? And it's clearly come from this high here. And what we can actually see as well, there's a small imbalance underneath here, so it really does make sense that that's what caused this. So looking at it that way, we could look to enter with our stop loss basically just above this 5-minute order block. So let's keep it still slightly above, just so that we don't get wicked out. So an 8.5 pip stop loss. Alright, so we're in the trade now, and prices started to break down. So you can see here, we've entered into the same trade, but we've got an 8.5 pip stop loss. And on the 4 hour, we've entered with a 35 pip stop loss. So let's see how these two trades play out. I'll just pull them side to side a bit. So looking at how it plays out on the 4 hour, it flies off. So if we would have entered with a 35 pip stop loss using the higher time frame for the entry as well as for predicting where the market's going to go, then we'd be looking at a pretty much 5 to 1, maybe 6 to 1. If we entered using the 5-minute time frame, but we still get involved in the move that is predicted based on the 4 hour time frame, then we can be looking at getting, well, at 1.25 to 1, but maybe 20 to 1. So you can see how we can manipulate the reward to risk ratio by trading the higher time frames for larger moves, and then looking at taking our entries on the lower time frames so that we can have a smaller stop loss. And that's the difference between getting involved in a move and getting a 6 to 1 out of it, or getting involved in a move and getting a 20 to 1 out of it. So yeah, I did obviously know what would happen because I'm just trying to show you guys an example. But in terms of manipulating the take profit by trading the higher time frames and manipulating the stop loss by getting involved using lower time frame entries, you can clearly see that if you trade the higher time frame moves and use the lower time frame for entries, that will result in you getting a much higher reward to risk ratio when your trade actually does play out as you've anticipated. Alright guys, so thank you very much for watching, and if you've enjoyed this video, I hope that you'll subscribe and click the notification icon. And if you've got any questions about this video or any of my other videos, then please leave a comment in the comments below. Thanks guys.